Hello, everybody. This is Tchaikovsky, and welcome to yet another intermediate accounting video. How exciting! This is my third. Maybe we'll even do a fourth today. But in any event, we're going to be talking tonight about basically this is part two in a series of four videos. We're going to be looking at some zero interest-bearing notes as well as some current debt. My disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only. It does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make references to publicly available information that is the copyright of other parties. I do not claim any right to the copyright that I'm referencing for those third parties. Okay, let's go ahead and we're going to be looking here at we're going to do a problem today of zero interest bearing notes, and we're going to talk a little bit about how debt is classified. So current maturities of non-current debt. So again, if we do have non-current debt, and it's oftentimes I know that people like to call it long-term. I'm not a big long-term guy, not because I can't commit, but really, actually, I used to not be able to. But I call it non-current because really, when you look at assets, whether it be current assets, the long-term. And I think in the minds of most investors, they think like 10 years down the road, which in the reality of it is, well, current means 1 year and non-current means beyond a year. So essentially, when you have current maturities of long-term debt, the portion of long-term debt within the next fiscal year must be classified as a current liability. Now, we will be excluding from current liabilities if the debt will be retired by assets not classified as current, refinanced from proceeds of a new debt issue, or converted into capital stock. And this is really going to be very situational. And in terms of for short-term obligations, there are some refinancing rules. We're going to exclude from current liabilities only if one of the following is met. Remember, this is excluding. And here we go. The liabilities contractually due to be settled more than 1 year after the balance sheet date would not be current. The entity has the contractual right to defer settlement for at least 1 year after the balance sheet date. Now, again, this is something that you would want to make sure that it was clearly in there from the parties that, okay, it's not going to, if they do defer it, it's not going to be some crazy 100% penalty. If that was in fact the case, that would actually have to be disclosed. And again, when you're kind of going through this refinancing agreement must be in place by the balance sheet date to classify as long term. So again, if in fact you have debt, and this is actually a really important point. So if you have debt that was say due on 12/31/26, and you basically then refinance it, but you do it in the following year, you would still need to be showing it as short term because the refinancing agreement did not happen until the year after. This will become a subsequent event. So the required footnote disclosure is a general description of the financing agreement. Again, terms of any new obligations incurred, terms of any new equity securities issued. And I'm just going to pause really quickly because I want to find some disclosures of debt that are out there for us to take a look at. So here again is like basically some just as an example, like we're looking over here at Johnson and Johnson. As you can kind of tell, they have and listed in there basically over here, they have various different notes that are due over different periods of time. And when we look over here at the borrowings, the components of long-term debt are these various different notes. And then you would basically go through over here, the current portion, obviously you're showing over here, and then basically the total long-term debt. And then over here, the fair value, there's a lot of different things for long-term debt, which we're going to get to in the next section. And then over here, like the current debt balance as of December 28, 2025 includes 6.5 billion of commercial paper that has a weighted average interest rate and a weighted average maturity of approximately 2 months. Current debt balance is so right over here. So again, when you look at basically the disclosures, essentially over here for the debt, Again, this is just something we're going to be looking at kind of like on a case by case basis. But again, remember the key is over here is that as far as if you are going to basically be refinancing, there's going to be some different parameters or different thresholds that are going to be essentially be put into place. So now, the one thing I do want to kind of mention here, and we're going to do a problem that involves this today, which is the concept of, is there such thing as interest-free debt? And the answer is no, is that the interest has to basically be imputed, meaning that when we see something that says, oh, it's interest free, no, nothing is free. So what we're going to be ending up doing is basically using a market rate of interest to kind of go through and to impute that debt. And then we're going to go through and amortize that discount using the effective interest method. Now, there's also essentially straight line amortization, which would not really be as long we could use straight line as long as it's not materially different, but we are required to use the effective interest method. And I'm going to go through those right now. So here's the example we're going to look at. And this is an old exam question that I basically pulled out. Of course, you've got my Freddie Jason tribute, right? So Friday the 13th and Nightmare on Elm Street purchased equipment on January 1st, 2022 by issuing a note for $800,000 on 12/31/25. The note does not bear interest and the fair value of the equipment is not readily determinable. For FGI, the market interest rate for a similar note is 10%. FGI uses straight line depreciation to depreciate its assets. The equipment is estimated to last for 6 years with no salvage value. FGIs record any interest expense using the effective interest method for any discounts. So it's asking us to record the purchase of the equipment on 1/1/22. So the first thing to kind of remember is that, well, if we kind of have like this line over here and we kind of say to ourselves, well, we've got over here 1/1/22, 12/31/22. And so kind of what's happening here is that this amount, so we're kind of telling people is, hey, we're not going to have to pay this 800,000 basically for 4 years. So what do we need to do? Well, the first thing we need to kind of go through and do is this is a zero coupon note or a zero interest bearing note. So is $800,000 today the same as $800,000 tomorrow? And the answer to that is no, because if I took 800,000 and basically if I was earning an interest rate of 10%, right at the end of year one, the value of this basically would be 880,000. If I then took that 880,000 and reinvested it, the value of this would now be 968. And again, if I took that amount and reinvested it at 10%, so now we're getting over here, and then in that very last year, so if I took 800,000, if I could get 10% on my money, and this would basically be worth 1.1 million. So in accounting, what we need to do is we need to say, well, wait a second. What is going to be the amount of this? If this amount here is 800,000, right? The amount that's being paid out in 4 years, or at the end of December 31st, 2025, how do I figure out what that value is today? And so what we're going to do is we're going to basically go to the present value of a dollar table. And when we go to this table right over here, we need to know two things. 10%, which is going to be the market rate of interest, and then 4 years, or basically 4 periods, basically is how interest is being compounded. So present value of dollar, this is used for lump sum payments, okay? Just one-time payments. I'm going to go over here, 4 periods at 10%, and this is going to be 0.68301. I'm going to go ahead and bring this back over here. So I'm going to take this amount, this 0.68301, I'm going to multiply this by 800,000. And so if we look at this, if I take 800,000 times 0.68301, so the value of this note is really going to be 546,408. Well, what does that really mean? Well, if we took, instead of this 800,000, if we did 546,408, wow, if I'm basically investing this at 10% per year, earning that interest gets reinvested by the end of days or by the end of year four, this is going to be worth close to within a couple bucks of $800,000. So when we look at this, when we're getting this equipment, right, this equipment is not worth 800,000. Why is that? Because it's really going to be worth 546 because we have this interest rate. So the way I'm going to go ahead and do this is when I go ahead and this is just something I'm going to kind of go over with all of you is my magical T account. I've got assets equals liabilities plus owner's equity, ERDC, right? So what does this mean? Assets typically have debit balances. They're increase with debits and then decrease with credits. Uh, Liabilities and equities typically have credit balances. They're increase with credits, decrease with debits. I record expenses with debits. I record revenues with credits. So coming over here, when I kind of say to myself, okay, how do I want to go through and record this on 1/1/22? Well, we are receiving equipment, but this equipment is really worth 546,408, right? So this is basically what this equipment is effectively worth. But I'm going to record the note payable right over here at 800,000. Okay, so right over here, I'm going to be recording this at 800,000. Now, what do I need to do to balance? This is going to be my discount on notes payable. And what this is really going to do, it's going to be the difference between these two right over here. This is really representing the interest expense on this note. So that's kind of how we're going to be going through and taking a look at this. And then, of course, with my journal entry, this is my date, my account, my debit, my credit, and then over here to record purchase of equipment. So if I were to basically go through and do this using T accounts, over here, I would be having equipment. I would then have a note payable. This would over here be at 800,000 and my equipment would be recorded at 546,408. But then again, with my note payable, I'm also going to basically have over here, I'm going to be having a discount on notes payable. And my discount on notes payable will be right over here at 253,592. Okay. So now, what do I need to go through and do next? Well, it's then asking me to go through and to record the journal entry for depreciation expense. Well, the first thing I want to kind of know is like, well, I use straight line. That's really exciting. Okay. So, and the equipment will last for 6 years and have no salvage value, right? So the way this is going to work for to record the depreciation expense, 12/31/22. Obviously, I record my expenses with debits. When I record depreciation expense, I'm going to basically be debiting depreciation expense. And then I'm going to be crediting what we call after the death of Christ. No, we're not doing a religious thing here today. No, this is accumulated depreciation on equipment or what I call AD equipment. Now, how do we compute straight line depreciation? Well, going back over here, I'm going to have basically my acquisition cost minus my salvage value divided by my estimated useful life. So my acquisition cost is 546,408. My salvage value, it tells me, is 0. My estimated useful life is 6 years. So my annual depreciation expense is going to be 546,408 divided by 6, or 91,068. So every single year, I'm going to basically be going through and saying over here, like, well, I'm going to basically be debiting depreciation expense for 91,068, and then I'm going to be going through and crediting the accumulated depreciation on the equipment. And I'm going to put down over here to record depreciation expense. Now, what happens with depreciation expense? This is an expense, so it's going to be closed out to retained earnings. But over here, when it comes to the equipment, this is a contra asset account. It reduces the carrying value of that equipment. So over here, we're going to be basically be taking this, and we're basically going to have over here, this is going to be accumulated depreciation on that equipment. And so then we would basically be recording, we basically would debit depreciation expense. Go ahead and do that for you right now. Just kind of go through and finish this out. So every year, we got 91,068, and then we got 91,068. Okay, so we've got our accumulated depreciation on equipment, and this is going to be basically the entry we would be going through and making for the next, like, say, like 6 years. Okay, so let's get to the more tougher ones. Prepare the journal entry to record interest expense for the year ended December 31st, 2023. Now, this is kind of a trick question because we are going through and using the effective interest method. What we are going to try to go through and do is we want to take this and then basically say, okay, so we've got this amount here. We're going to basically amortize this to interest expense. So every single year, as we're going through and doing this, we want this ultimately to go down to zero, right? This is going to be our goal. We want to get this discount on notes payable down to zero. And the way we're going to do that is we're going to record it through interest expense. So the journal entry we're going to make is we're going to have interest expense, and then we're going to be crediting discount on notes payable. Now, the reason why we want this to go down to zero, because if we look at the current carrying value of the note, right? So in our liability sections, we're going to have current liabilities. And then we're going to have over here, we're going to have our non-current liabilities. And as of 1/1/22, our non-current liabilities are going to be notes payable. And the notes payable here will be 800,000 less discount on notes payable. And this over here is going to be 253,592. We'll make this little notation here so that our notes payable net of the discount. Always it's wrong. So our notes payable net of the discount right over here is going to be a total of 546,408. Now the goal is that when we get over here to 12/31/22, we're going to have 12/31/23, 12/31/24, and then 12/31/25. Our ultimate goal is when this note's going to basically be repaid, we want the discount to basically be at zero, because that's ultimately when this note gets repaid, it's going to have to be repaid at $800,000. But we're going to basically get rid of this 253,592 by amortizing it to interest expense. Okay. Now, what's interesting is right over here, and I kind of made this little mistake as I'm glad I'm like doing this. Well, as of 12/31/24, this non-current liability is now going to become a current liability, right? So this is going to basically be notes payable less the discount on notes payable. So when we get over here to 12/31/24, this amount here is going to basically be a current liability, right? So once we get here, why is it going to be current? Well, when we get over here to 12/31/24, at that point in time, it's going to basically flip, right? Because over here, it's non-current because it's basically due more than a year from now because it's due on 12/31/25. But when we get to this balance sheet date, now it's going to become a current liability. Okay. So how do we go through and amortize it? Well, this initial amortization table I showed you is going to give us a kind of a clue of how we go through doing the effective interest method. So the first thing we're going to do is we're going to basically see what is the note payable carrying value. Okay, so as of 1/1/22, let's call this, let's do 12/31, we'll do 1/1/22. So my note payable carrying value is going to be the 800,000. Okay, less the discount. The discount over here is 253,592. So my carrying value is going to be 546,408. Now, the first entry over here, I've got my interest expense or my interest rate. My interest rate is at 10%. So the amount of interest expense I'm going to be going through and recognizing is going to be 54,461. So how do I go through and make my journal entry? Well, the journal entry is always going to be over here. This is going to be as of 12/31/22. I'm going to be debiting interest expense of 54,641. And then over here, I'm going to be crediting discount on notes payable for that same amount. So this is going to be to record interest expense. Now, when I do this, my discount on notes payable is going to be going over here and decreasing. So now my new balance sounds like a shoe is. My new balance over here from discount, you need dad jokes, so I apologize in advance. My new discount on notes payable as of 12/31/22 is going to be 198,951. So when I look at my balance sheet right over here in my non-current liabilities, my new note payable net of the discount is going to be 601.49, right? So the first year, which I know I was not asked for this, right? Because the question is actually asking us to basically say, well, we did the depreciation, that's done. We did the journal entry to go through and record this transaction. But what about interest expense for 12/31/23? Well, what we have to go through and do is because to do 2023, because this process here is what we call the effective interest method. I'm going to show you how to do the straight line momentarily, but we're doing the effective interest method. We're doing this by basically figuring out what my carrying value is. So we'll call this 12/31/22. Now for 12/31/23, right, my note payable amount basically, and we'll call this note payable carrying value. So my new balance here is 800,000 less my discount on notes payable, which is now going to be 198,951. So my new carrying value is 601.49. So over here, my interest expense is going to be 60,105. So on 12/31/23, My interest expense is 60,105. My discount on notes payable is going to be 60,105. So to answer this question here is, what is the journal entry to record interest expense at 12/31/23? It's going to be right over here. This would basically be my journal entry to record interest expense as of 12/31/23. But notice I had to do the year previously in order to get this year over here because I'm using the effective interest method, which means I'm computing interest based on the carrying value every year of that note payable. So that's 12/31/23. What would my balance sheet look like? Well, my balance sheet over here for 12/31/23, what is that going to look like? Well, I'm now going through and amortizing this by 60,105. So now my new carrying value on my discount on notes payable is going to be over here at 138,846. Come over here, my new carrying value of my note or my balance sheet presentation is going to be a non-current liability. Because why is it a non-current? It's due on 12/31/25. It's more than 1 year beyond the balance sheet date. So that's how we kind of get to this result over here, but this would be my balance sheet presentation. Non-current liabilities, notes payable less that discount on notes payable. Now, when I come over back over here is to basically go through and say, okay, prepare the classified balance sheet liability sections for note payable only. We just went through and did this, but what I want to do with you right now is to do two more things. Let's go through and make sure that we did this correctly by completing the task. So we're going to do 12/31/24, and for even more fun and excitement, we're going to go ahead and do 12/31/25 as well. So for 12/31/24, my note payable carrying value is going to be 800,000 less the unamortized discount of 138,846, giving me a note payable carrying value of 661,154. So the amount of interest expense I'm going to go ahead and recognize is going to be 66,115. Okay. So that's how I'm going to go through and basically do this over here. I now come over here and basically say, okay, now what does this look like? Well, when it comes to the discount on notes payable, we're just going to kind of continue on with this like right over here. By the way, I think I sound like that Bob Ross dude who says, okay, we're going to paint this little tree right over here. This is exciting. Yeah, this is accounting after dark. It's like almost midnight here on a Saturday. Exciting stuff. So thank you for being with me here. So over here we're amortizing that discount on notes payable. So as of 12/31/24, my unamortized discount is now 72,731. But notice here on this date, right over here, I'm now going to be basically saying, well, this is going to be a current liability. Why is it current? Because it's going to be due within the next year. Okay, so we promised we would do this for one more year. I come over here to 800,000. Now my discount is basically 72,731. I'm going to multiply this through. And now my balance here is 727,269. And lo and behold, my entry for interest expense is now going to be 72,727. Now, if I look at this over here, now when the note gets paid off, right, we kind of set our initial goal here was that we wanted we've got a visitor. This is exciting. So we wanted our goal was for this right over here was to basically say, okay, we want this amount to be zero because as of 12/31/25, oh yes, okay, we're gonna take a little cat break. So this is Ozzy, the most amazing cat in the world. Ozzy, we want to say hello to the world of accounting. course, when I try to pet you, this is when things go wrong. Ozzy, you're the most amazing cat. And so let me give you guys, we need to take a kitten break. There we go, Ozzy. Do you see yourself on screen? You're absolutely internet famous. It's pretty exciting here. There we go. Yeah. All right. It's always better when you zoom bomb my videos. By the way, I'm not running for governor. So I'm not going to say like some gubernatorial cabinets like Ozzy, get out of my blank, my trucking shot, right? We're not going to go through and do that. Okay, yes. Okay, but I'm going to pause this right now because I think that I don't want to put my viewers here to sleep. I think I'm actually already doing a pretty good job of that. But let's go back and take a look at some more accounting. So give me just a moment here. Yes, Ozzy, there we go. Okay. So now we've got over here, what's going to be our amount here? Well, we're taking over here, we've got our little sort of basically watch the tail, and I'm amortizing this over here by another 72,727. And our goal was is to make this go down to zero. Right, but it's at $4. So I'm just going to go ahead and round this up. Okay. So this is now basically at zero. And what else would be happening? Well, the other entry we would be making on 12/31/25 when this note would basically be paid off is that, well, if we're paying off the note payable, we would basically be debiting cash, or excuse me, we would be debiting note payable and we would be crediting cash. And this would basically be for 800,000. And that would be the last entry we would go through and make to basically go through and pay this thing off. Okay. So that's kind of how we do like using the effective interest method if we have a zero coupon note. But remember, this is the key thing, right? Because as of here, basically now we're ready to pay this thing off. So we've got the note payable. By the time the note's going to mature, it's going to basically be down to zero. If we actually did pay this off on 12/31/25, this amount would be, in fact, be zero on our balance sheet. Okay. Now, the one thing I wanted to show you is that what if we chose straight line? So if we did straight line amortization of the discount, okay, what would this exactly look like? Well, our amount of our discount over here was 253,592. How many years are we amortizing the discount over? Well, it's being amortized over 4 years. So the amount, if we were to do the amortization straight line, I would basically be going through and doing 63,398 every single year for a period of 4 years. Now, if I looked at this in terms of going through and looking at in terms of interest expense, right? So if this was the same amount I was going to go ahead and do every year, we would basically say, well, we can't do it we can do it as long as the difference is not material. So this is really interest expense effective. And this is going to be interest. Wow, Austin, you're going to sit right on the keyboard. God, if you guys can only see this. Interest expense straight line. Okay, so those are the two things we've got going on here. Now, if I look at the differences between these, right, and every year, right, we've got these different amounts, right? So this is the difference between the two. Now, if I take this amount here and show, okay, this as a percentage of the effective interest is about 16%, one may be able to make the argument that, okay, anything above 5%, or, again, that's usually more pegged for auditors, but is it really that material of a difference? And you could probably make an argument for it like either way, right? If it really was like, say, 1 or 2%, it might be okay. But again, we'd be using the effective interest rate unless the amount between the interest expense using, say, straight line versus, doing it effective, if there was that large of a difference. So that's pretty much answers most of the parts of this various different question, which brings us to the end, unfortunately, of this meeting with you here today. And as we kind of go through and look at this, and I've got a cat that just, wanted to answer my iPhone for me, so he's jumping all over that. But again, kind of coming back over here to this concept, is interest-free debt ever really a reality? And the answer is absolutely not. We have to go through and we have to impute interest. So that's what we're doing, and that's what we just did in this last example. Hopefully you found this to be helpful. And thank you for watching. Please like and subscribe if you like more cat videos. I can see if Ozzy will come over and hang out with me, and always more fun than doing intermediate accounting. Anything with a cat is more fun than intermediate. But please make sure to like and subscribe. Feel free to leave a comment or email at ibc30tocp@gmail.com. Thank you for watching, and I will see you on the next video.